Welcome to ForexTV.com. Today's Monday, March 23rd. I'm Tim Kelly with your New York Forex market buzz. Dollar's relatively flat against the euro and British pound. It is gaining ground against the yen, weaker against the Canadian and Australian dollars at midday. U.S. equity indexes are holding better than 2% gains on the session, and oil and gold are slightly weaker. Now for a look at the latest headlines from the CEP news desk. U.S. Treasury to spend up to $1 trillion on toxic debt. U.S. existing home sales see strong rebound, and the Bank of England's Blanchflower says UK recession may be worse than expected. U.S. Treasury to use up to $1 trillion to support toxic debt market. U.S. Treasury announced Monday morning it will spend up to $1 trillion in a bid to provide support to the balance sheets of financial institutions and support the toxic debt market, which includes mostly mortgage-backed securities. U.S. Treasury will invest between $75 billion to $100 billion from its existing Troubled Asset Relief Program, the TARP, and it plans to set up a separate initiative will use the Federal Reserve's Term Asset-Backed Securities Lending Facility and FDIC funding to finance highly anticipated private investment program. That's the PPIP. 5 different private-public funds will be bidding on toxic assets and sell them to the broader public. Meanwhile, the FDIC will guarantee private sector loans for these purchases, while the U.S. government will invest side by side with private equity using taxpayer capital. In a press conference following the official announcement, Geithner said he expects significant interest from the private sector, a sentiment which was confirmed by PIMCO's Bill Gross following the announcement. Geithner said that while there is no doubt that the U.S. government is taking risk with the PPIP, the taxpayer stands to make substantial returns on the investments. He also said that the Treasury should be able to implement the PPIP quickly. On the housing front, U.S. existing home sales climbed beyond expectations. U.S. existing home sales climbed well above expectations on Monday, a welcome respite from the mostly dismal news on the U.S. housing sector. Existing home sales grew 5.1% in February against expectations for a 0.9% decline and following a 5.3% drop in January, that according to the National Association of Realtors. Sales of single-family homes rose 4.4% following a 4.7% decrease in January, while sales of condos and other multifamily units climbed 11.4% against a 10.2% decrease the month prior. The average price of a single-family home in February was $209,600. White House advisor Summers says investors eager to share in toxic debt plan. The White House economic advisor Lawrence Summers said Monday there's substantial private investor interest in the government's public and private partnership plan to take bad assets off banks' balance sheets. Stocks rallied from the announcement Monday morning, and Summers reacted by saying, "We're gratified by the market reaction." Summers said U.S. Treasury Secretary Timothy Geithner's plan is aimed at thawing credit markets. As markets stabilize, the taxpayer's role in financial markets will diminish. Summers added in that press conference that investors participating in the bad debt plan will not be subject to salary caps. Elsewhere in Canada, leading economic indices declined for a 6th month in a row. Statistics Canada composite leading indicators continued to come under pressure in February, falling 1.1% for the month. This constitutes the data point's 6th consecutive month of contraction. Pullback was worse than both the 0.9% contracted expected by economists and the previous month's revised 0.9% decline. According to Statistics Canada, 9 of 10 subcomponents contracted, including an 8% decline in the housing component, a 7.5% fall in equities, and a 4.8% pullback in new orders. The only subcomponent of the index which improved was M1 money supply. That advanced 1.8% compared to last month. Over in the UK, the Bank of England's Blanchflower says the UK recession could be worse than expected. The BOE's Blanchflower said Monday that the recession in the UK could last longer than most are expecting. Quoted as saying forecasters in a recession tend to be overly optimistic. That's speaking at an event in London. The BOE policymaker said England requires a large fiscal stimulus in the short term, which should be aimed at creating jobs. Blanchflower added that there'll be a massive climb in unemployment in coming months, especially June, when school and university students graduate and begin looking for work. He also said the falling value of the pound has done nothing to boost demand for manufacturing products out of the UK. Today we're joined by Andy Busch, Global FX Strategist at BMO Capital Markets. Andy, thanks for joining us on the program.
Sure, my pleasure.
Andy, the main headline today, I think in the secondary headline first is the Treasury announcement, and then supported by some better than expected news on the housing front. Andy, given your background in political affairs, what do you make of today's announcements?
Well, the first thing is that Geithner made an announcement back in February 9th, that he was going to have a bank recovery plan, and he didn't provide any of the details. Today, he's actually fulfilled his press conference on February 9th, and the markets, the equity markets are reacting extremely favorably. The financial component of the S&P is rallying significantly. It's up about 8%. So the market is really enjoying a nice ride today. Part of it's coming back from a near-death experience, but also the other component, as you mentioned, is clearly the increase in the existing home sales. Sales of single-family units are critical for so many banks and their real estate loan portfolios. As long as those sales were depressed and the prices were depressed, then the assets that were held by the banks were under pressure as well to be reduced in value. So today there was a double shotgun approach here, that we've gotten two nice pieces of news, and we've seen clearly a very strong rally.
Andy, on the S&P front, we're right now holding that 800 level. Do you see that as key level from the technical perspective, or is that something that is just part and parcel of this recovery, or this whatever you want to call it, bear market rally or recovery?
Well, at 800, about between 800 and 810, those were previous lows for several months, and we bounced off those levels and went higher. And then once we broke through there, we made the new lows on this downtrend. So to get back above there would be extremely helpful. But perhaps if we can get back on top of 815 or 820, we could see a move to as high as 860. But I don't really see that maintaining. So whatever we see on the upside here, I would be somewhat reluctant to get too excited about it, especially once we get above about 840. So I'm looking for another 10% maybe from these levels, and then that should be about it.
Okay, so the currencies following equities at this point,
right?
And we're in a range right now with euro right now 136.20. It had been up another 100 pips earlier, 137.36, and yen right now climbing somewhat. Dollar climbing against yen 96.87. Had been up well over 97. You think these levels hold as well, or do you think we're kind of toppish here?
Well, part of the problem is you mentioned the Trichet interview in the Wall Street Journal, in which he mentioned that they could cut interest rates even further. I think that surprised a few people in the market, and they end up taking some profits. Clearly the biggest winners today are the Aussie and the Kiwi. They've rallied significantly in the belief that we're going to get significant relief from underperforming assets on the bank's balance sheets, and therefore that they would begin to relend, and maybe also because of the existing home sales. So, overall, these things have run really far. I mean, the euro, the Australian dollar is up 10 days in a row, and that doesn't mean that it can't continue to go, but we probably over 77, we're going to struggle a little bit here. I would imagine as we get to about between 77.5 to 71, there should be fairly decent interest to take some profits from people. We had peaked out above, I believe it was 72 in early part of January, before putting in the new lows below 63. So once we get up kind of within that framework, we should start to see some longer-term sellers come in.
So about 72, you would then see maybe some acceleration to the upside, up to that resistance at 77?
No, what I'm saying is that I don't see it going back above there. I think there's resistance now from 70.5 to 72. So it would take some time or some additional positive mojo in this market to get above 72 right now.
Okay, and how about, I'm just looking at Canada right now, 122.90. Had right about the session lows right now. What do you see in speaking of commodity currencies? Oil relatively flat today after a couple of up days. What do you make of Canada?
Well, as you mentioned, we had some, the leading indicators came out weaker than expected. We really don't have anything for the rest of the week in Canada as far as economic data goes, and it's still not quite performing as strongly as Aussie and Kiwi. Part of that clearly has been tied to its closeness and proximity to the United States. I think Aussie and Kiwi get a bigger push when they see developments in China that appear to be positive. So they're much more closely tied to the developments in the Far East than Canada is as far as getting a pop from commodity currencies. But it still will participate. We see that oil and natural gas have also had a pretty good pop today. Those things are all helping the Canadian dollar as well, but it's certainly an underperformer at this time.
Andy, I want to leave it off with sterling. Right now, 145.41. That continues to trade in a very broad range on a daily basis. Considering the BOE statements, what do you make of sterling at this point?
Yeah, I'm still not a real big fan. I mean, overall, I don't like the U.S. dollar, and I haven't liked it for some time. I'm still expecting it to experience quite a bit of duress towards the end of this year, coupled with the reasons why are the huge U.S. Fiscal deficit, coupled with the Federal Reserve announcing on Friday that they would start to seriously quantitative ease. So I think I've been on your show before saying that I expect the euro to get potentially as high as 160. Although in the sterling, I don't see it being able to retrace quite to what we saw when the euro was at 160. That would have been sterling at 210. But right. I think we can get up in the 175 region.
Well, I think your sentiments are shared about not liking the U.S. dollar, except when you have more of them in your wallet. Anything else on your radar right now that you think we should be looking at?
No, we're just going to spend some time trying to figure out this program that the Treasury's announced and all the different behavioral kind of science components to it, how the actors will play out and what the participants will do. Because I'm not sure right now that there's enough incentive for the banks to actually sell these assets yet.
Okay, Andy, we're going to leave it there. I appreciate you for joining us again.
You bet.
This has been your New York Forex Market Buzz with Andy Busch of BMO Capital Markets. I'm Tim Kelly. Join us later this afternoon for PM Exchange right here on ForexTV.com.